Hello there, my name is Ben Walker and I'm here today with the help of Promise Yourself to talk to you guys about some of the things that we're just not taught about at school, be that mortgages, buying a house, renting, taxes, all this kind of stuff. And today I am actually going to be talking about taxes. Now, of course, there are a wide variety of different taxes, so I'm not going to be able to talk about all of them. Instead, I'm going to focus in on some of the ones that are slightly more common and you're more likely to come across. Now, of course, the first tax I'm going to talk about is income tax. Now, this is something that is very simple. You pay when you earn. Now, you have to earn a certain amount of money, but if you're making money through a job, through saving, interest from savings, from a trust, from rental income, from a wide variety of sources, then essentially, if it's over a certain amount, you have to pay tax on it. That's the law. And you may have heard over the years, quite a few people have tried to get around that. But it's quite simple, really, once you actually get your head around it. The more you earn, the more tax you pay. There's various different bands. I'm not going to go into a huge amount of depth on this one because if I were to just start blurting out loads and loads of numbers at you, chances are you're going to get slightly bored. So read the guide that goes along with this if you are curious, because it breaks down the different tax bands there are. But I will say that there's a personal allowance. So that means if you, basically, this amount of money doesn't get taxed. So in England, Wales and Northern Ireland, it's £12,750. And then in Scotland, it is £12,570. Scotland has got a very slightly different tax system. So if you are from Scotland, I will be using mainly the England, Wales and Northern Ireland income tax brackets. But the Scottish ones are on the guide as well if you do want to have a look. But the way it's broken down is basically under £12,000, no tax. From £12,000 to £50,000, you get taxed on 20% of that income. But don't forget, the personal allowance still has zero tax. Now, from £50,000 to £150,000, it's 40% tax. And for £150,000 and more, you get 45% income tax. So the tax bracket moves up as you start earning more money. And like I said, in Scotland, it's a little bit more complicated. But how do you pay tax? Now, you can do it one of two ways. The first way is if you're an employee, then you pay through the pay as you earn system. So what will happen is your employer will send how much they're paying you off to HMRC. HMRC will have a look and go, right, this is how much they earn, this is how much tax they pay. Now, the problem with this is they may not always have the correct information. So it's very important to keep HMRC updated with your current working conditions, whether you're working one job, two jobs. You really don't want to be put on an emergency tax code, because if that happens, you'll get taxed more than you're meant to, and then it's a right faff trying to get it back. I'm pretty sure they still owe me some money. So really it's all about being diligent and knowing what tax code you're on, making sure the company you're working for is working with you on this as well. If it's just you fighting a one-man battle, it's probably not going to go too well. Now, the other way you pay tax is with a self-assessment tax return every year. Now, you can do this if you're earning money through interest from savings or the various other things I mentioned. There's more on the guide, by the way. But also, if you're self-employed, then you have to do a self-assessment every year. Now, that is how you'll say, I've earned this much money, and then they'll come back and say, this is how much tax you owe. So again, it's a fairly simple, it's a lot of paperwork, but it's a fairly simple process if you are self-employed or if you're making money through other avenues. So the whole process of income tax isn't anything to be too scared about, but really it's more of an annoyance rather than an outright grievance. Now I'm going to move on to the next tax now, which is capital gains tax. Now, this is a payment you have to make when you sell an asset for more than you bought it for. That's as simple as I can make it. Now, of course, there's lots of stipulations and rules and regulations that come along, which I'm going to dive a little bit into, not too much, because obviously don't want to overload you. But like I said before, there is more information in the guide that comes along, so definitely go and have a read of that. Now, you may be thinking, what classifies as a valuable asset? Now, that could be anything from a second house to cryptocurrency. There's a whole wide variety of what it could be, even expensive jewelry. So just make sure that you know what you are doing when you're buying one thing and then selling it for a profit. But just so you know, the only way to report capital gains tax is through a self-assessment tax return. So make sure if you are making a big profit on something at some point, you are reporting that. Otherwise, if they find out, you could get fined a whole load of money. And in some cases, the fine could be worth a lot more than what you actually owe them. So just make sure you are being quite diligent with that, because you don't want to be fined too much money for not filling out a form. Now, I'm going to talk a little bit about the rates and allowances that you get with capital gains tax. So there's two different rates. There's the basic rate and the higher rate. Now, of course, that depends on the rest of your income and whatnot. So essentially the basic rate, it means that on, as of 2022 that is, on residential property gains, so in the money you make off selling a residential property, you pay 18% tax on the profits, and with all other valuable assets, you pay 10% tax on the profits. However, the higher tax rate is 28% on residential property profits and 20% on other valuable assets. But the good news is there is a capital gains tax allowance of £12,300. So if you make a profit underneath £12,300, so for example, let's say you buy a second home for £100,000 and then you sell it for £110,000, that £10,000 is underneath the allowance, which means that you wouldn't have to pay tax on that profit. So if you sell something for a profit but underneath the allowance, it's happy days, you don't pay tax. And if you're in a joint partnership or a civil union of some sort, then you actually can combine your allowances to get £24,600 worth of an allowance, which means obviously you could make a bit more profit without having to pay as much tax, if you follow my drift. So it really does make sense if you're able to combine your capital gains tax allowances if you can. Now, fortunately, if you're selling your primary residence, so it's a house that you primarily live in, then you don't actually have to pay capital gains tax on that property. But if you're selling a second home or a buy-to-let property, then you'll have to pay either 18% or 28% on capital gains tax. So bear that in mind, that if you are selling your primary residence, you don't have to pay additional tax on top of selling that. Now, when it comes to calculating capital gains tax, that can be a very, very difficult thing to do, especially if you're doing it by hand. But fortunately, there is a capital gains tax calculator on the government website that I'd highly recommend you use if you need to. There's a link to it on the guide as well, so if you want to go check that out, have a look, see if it helps you. But if you're trying to do it by hand, you might make an error. If you do make an error, then you could get fined a massive amount of money. So it really does make sense to do it with a calculator that you know is going to be correct, and that way you could save yourself a whole load of hassle and a whole load of money. And like I said earlier, when it comes to paying the capital gains tax, you just pay it on, well, you just declare it on the self-assessments that you have to fill out if you make money, basically. So once you're filling out your self-assessment tax returns, write down how much you made, and then capital gains tax can be calculated from there as well. And that way you can declare it, happy days, no fines. One thing that you do need to bear in mind though is if you need to declare capital gains tax on a residential property, then you can't wait for the self-assessment. You have to declare it within 60 days of the sale. And once again, there's a link on the guide that goes along with this to tell you guys how to do that. So if you have made or are planning on making a residential property sale and you will make some money from it, have a look at that link and it'll tell you what to do. The next tax I'm going to talk about is inheritance tax. Now, obviously, when you're dealing with inheritance tax, it can be a very difficult and trying time. So I'm going to try and break this down as simply and easily as I can, but obviously there's quite a lot of detail that I do need to get through if anyone's to understand what I'm actually talking about. Now, first things first, there is a threshold that you don't have to pay an inheritance tax on. Can't say all today. So if the value of the estate that's being passed on is worth less than £325,000, you don't have to pay inheritance tax. Now, if you're going to use that threshold to basically give money away to your friends and family, then any money that's left, or value of the estate that's left over the 325,000, if it's given to a spouse or a civil partner, a charity or an amateur local sports club, then you don't have to pay inheritance tax on that. So that's a way to kind of get around the system, so long as you do have one of those 4 options around you to choose from. Now, of course, if you die before your spouse, then you can basically just leave all the money to them, and it's happy days. You don't really have to pay anything on that because it's just going straight over. But if you're giving your home to children or stepchildren, then the threshold is increased to 500,000 rather than 325,000. So theoretically, if you were to pass away first and give the entire estate over to your spouse, then they could use your threshold as well. So the maximum you can really work out would be around £1 million threshold if you're giving it all to stepchildren or children, essentially. So it's quite a lot of finicky details. I would suggest reading the guide because that explains it more clearly than I ever could. So now I'm going to talk about the rates. Now the rates for inheritance tax are quite hefty. For everything that is over the threshold would be charged at 40% inheritance tax. So that's how much of the estate would have to be paid off over the threshold towards the government. Now, of course, that threshold could either be 325 or 500,000, depending on what's going on with the estate. But if you give 10% or more to a charity, then 10% of more of your estate to a charity, then the inheritance tax decreases to 36% rather than 40% tax on anything over the threshold. So that's another thing to think about. Now, there are various other reliefs available with inheritance tax. For example, if you were to gift something to someone before you passed away, then that would benefit from something called taper relief. But it involves a whole load more reading, so I suggest doing your own research on all of this because it's so much more than I can fit into a video. So yes, definitely do as much research as you can if you are in the situation where you're thinking, what should I do with my estate? And learn as much as you can, of course. Now, you're probably wondering who actually pays. So the estate will pay at the time of the person's passing. So essentially, what I'm saying is the beneficiaries really shouldn't have to pay. There are obviously some occasions where they may. For example, if they've been left a buy-to-let property, they still have to pay tax on the profits. But generally, the estate should be paying the inheritance tax. Now, with regards to gifting, there are plenty of rules and regulations, but as long as you gift less than the threshold of £325,000 and you pass within 7 years, you shouldn't have to pay tax on that £325,000. So again, plenty of research needed doing, so make sure you're doing your own research if you are in this kind of scenario. Now, a tax that pretty much everyone has to deal with pretty much every day of our lives is VAT, or value added tax. Now, there are 3 tax rates. There's the first one, which applies to most goods and services, which is 20%. And then there's a reduced rate, which applies to a few of the goods and services, which is 5%, and there is none. Some goods and services have 0% value added tax. But as consumers, you really shouldn't be having to think too much about what the VAT is on the things you're buying. It should all be included with the price, especially in the UK, that is. Now, the next one I'm going to mention but not really talk about as much is national insurance. Now, the reason I'm not going to talk about it too much is because it's just a whole load of numbers. There's various different bands involved and very different numbers for each bands and calculation. It all depends completely on your circumstances. So no matter what I say in this video, at the end of the day, it depends on what you yourself are going through with terms to your circumstances. Now, in the guide that goes along with this, obviously I've written down each band and what it essentially means for each one. But national insurance, at the end of the day, it should all be handled for you. So either you pay, similar to income tax, you either pay as you earn if you're an employee, and then it should be figured out for you once your slip comes in. It should come in and say, this is how much national insurance you paid, this is how much income tax you paid. Now the bad news is, obviously you have to cross a threshold to start paying national insurance. If 1 month you earn a lot of money, then you will pay more national insurance. If the next month you don't, it's tough luck, I'm afraid. You won't be seeing any of that money back. Once the money is gone to the national insurance payments, you won't be able to get it back. Whereas with income tax, if you're not set up under the correct tax code, and in 1 month you pay a lot of income tax, then you don't earn much for the rest of the year, it may be possible for you to claim that back. So that's the main difference there. But if you want to learn more about national insurance, I highly recommend reading the guide that goes along with this, because it goes into more detail about each of the different bands involved. Now, as I just mentioned, it may sometimes be possible to get a tax rebate or refund from HMRC. Now, of course, if you're if you're an employee and you're being paid through the payee system, pay as you earn that is, then it's all done for you, so you don't really have to be too involved. But sometimes the taxman doesn't have all the information that they need. So they may make mistakes, they may charge too much tax. If this is the case, you have to fill out a self-assessment tax return at the end of the fiscal year and basically say, you've charged me too much tax, I want it back please. So sometimes they do that themselves and they figure out that they've taken too much tax off you, but that's not always the case. So if you are being charged more tax than you think you should, fill out a self-assessment, and that way you should be able to get a tax rebate at some point in the future. Obviously I can't give any timelines, I can't give any definites, but it's definitely something worth remembering, especially if you are paid using the payee system, because sometimes they do make mistakes and do charge too much tax. Now the final thing I'm going to mention is HMRC. Now that's Her Majesty's Revenue and Customs. They're the ones who deal with all the tax stuff. So if you've got any questions about any of the stuff I've just talked about, go onto the HMRC website, have a look on there, do your own research as well, and of course read the guide that's going along with this. Now, I know that tax isn't the most exciting subject, but it's part of our daily lives at this point. So it's something that everyone really does need to learn about. Hopefully you've learned something from this video. I know I learned quite a lot when I was researching it. If you do have any questions, obviously comment down below, like and subscribe. My name's been Ben Walker, and I'll see you again next time.